Hello and welcome to our three-part series on all things funds. Today I'm joined by Rob Burdett, who works for BMO GAM. We're going to be talking active versus passive. Rob, over the past decade, passive has enjoyed a surge in popularity. Obviously, passive funds are a lot cheaper today than they were a decade ago. But has the other driver been growing scepticism around the ability of active funds to add value?
I think I should first declare my hand as agnostic on the active-passive debate, but it is fair to say, I think, that the passive industry has sold itself on the factual certainty of historic returns, and it is true in individual years that rarely does the average active manager beat the average passive. However, over longer periods of time, that is not true. And in certain market conditions as well. So I think we use both, and it varies in proportion. So I think that's the starting point. Also, I would say for private investors, if they don't want either to take advice or even pay for advice or make selections themselves, getting just a broad market exposure removes the need to do so. So they have a clear role for gaining equity exposure. Simply, cheaply and effectively.
I mean, they do seem to, passive industry and active industry seem to pitch itself against each other. That's why you get versus.
Yes.
But is it a case that for most investors, it's probably a more sensible approach is a mix and match between the two different styles?
I think so. I guess if passive is selling on historic facts, the active is selling on future hope, and that's a harder sell. And it is true that there are plenty of active funds that significantly outperform by a very big margin over time. So I think the industry has sort of got caught in this historic fact and future hope debate. At the same time, the regulator in particular has introduced a strong focus on cost. And again, costs are certainties, outperformances are not a certainty. So I think mathematically, statistically, the trackers have it, but we know from practical evidence that there are very good active managers out there that will offer you returns that are well worth taking the risk on the future hope.
At the current time, there's a lot of caution in the air, and I'd say that most investors are probably looking down rather than up. Yeah. Does that strengthen the appeal of active funds? And I was hoping you could give us a flavour in terms of what the current split is between active and passive in the funds that you manage.
Yes, so in our funds we have been as high as over 40% passive, but today we're down at less than 15. And it is because of the point you make. There's perhaps a less uncertain outlook. Lots of political issues, geopolitical issues, a very long in the tooth economic recovery, and so on. Usually every year, for the last 12 years, you've had at least a 10% correction. We've only had one of those in the last 3 years. So, odds are we may encounter some turbulence. And the last down year of any significance was 2018. And in that year, there were active funds that made you money. There were no passive funds that made you money in 2018, except in the US. Whereas in all other markets, there were active funds that made you money. And there are other studies that show in falling markets generally the odds get better in favour of active managers. It's cold comfort perhaps in falling markets that you're losing less, but that is what helps you with compound interest, which is the secret to long-term investment success.
Thank you, Rob.